Okay, good afternoon, everyone. Today is Sunday, the 28th of August, 2022, and we'll continue from our discussion, which will be the part 3 of our discussion with respect to consolidated statement of profit or loss. And today we'll begin our discussion from the perspective of acquisition during the year. That is, what will happen if a subsidiary was acquired in the current year. And recall our discussion ab initio was that consolidation of the results or accounts of the subsidiary commences from the date of acquisition. And the date of acquisition is considered the first date in which a subsidiary, control of a subsidiary has been obtained by the parent entity, which means it's from that date you start to consolidate. Therefore, what will be the implication of this, given that we acquire subsidiary probably in between the year, and what we'll do to the result of the subsidiary for that particular year? Are we going to consolidate it in full? Are we going to consolidate it in part? Or are we going to be exempted from consolidating it in the year of acquisition? And what do we do in that respect? Furthermore, down the line, we'll be looking at the implication of that on possible intercompany transactions or purported intercompany transactions, whether such require elimination with respect to intercompany sales and intercompany cost of sales, vis-a-vis if they are unrealized profit that we need to eliminate, if any. And all of these are what we're going to consider today. Vis-a-vis, we'll move to other aspects. When there's impairment of goodwill in a year, how do we account for it? Also, where there's a gain on bargain purchase in the year of acquisition, how do we account for it? All of these are what we're going to take into consideration today. Now, to do that, we'll venture back to our material that will make use of our text, where we'll look at question 14 of the text to see how we'll take into consideration acquisition of a subsidiary during the year. In that light, I want somebody to read this for us as we venture into our discussion. Acquisition during the year. We'll look at illustration 14. You can start with seventh principle, acquisition during the year. You can make 1 or 2 commentaries before reading the question. Over to you. Dennis, you can read for us. Thank you.
Okay, sir. Sir, from the 7th principle, right?
Yes.
Okay, sir. Acquisition during the year. In some instances, it has been observed that subsidiaries are sometimes acquired during the year. The implication of such acquisition is that part of the profit for the year will be pre-acquisition profit and loss, while another part is considered post-acquisition profit and loss or loss. Furthermore, it is necessary and essential to separate the subsidiaries' items of profit or loss into the pre-acquisition items and post-acquisition items, as only the post-acquisition items are required to be consolidated with the financial result of the parent as at the first reporting date. In summary, only the post-acquisition element of the subsidiary's profit for the year is consolidated. Illustration 14. Arsenal acquired 80% interest in the equity of Chelsea as 1st April 2016. The board of Arsenal strictly wants to comply with the requirements of IFRS regarding consolidation of the financial statements of the subsidiary with that of the parent as at December 31st, 2016. Income statement for the year ended December 31, 2016. Arsenal, Chelsea, all figures in thousand naira. Revenue 600,000, 390,000, Arsenal and Chelsea respectively. Cost of sales 345,000, 201,000, Arsenal and Chelsea. Gross profit 225,000, 189,000, Arsenal and Chelsea respectively. Distribution costs 75,000, 45,000. Administrative expenses 105,000, 90,000. Profit on before tax 75,000, 54,000. Income tax 25,000, 29,000. Profit for the year 50,000, 25,000, Arsenal and Chelsea respectively. Movement in reserves, retained profit brought forward 120,000 for Arsenal, 65,000 for Chelsea. Profit for the year 50,000 Arsenal, 25,000 Chelsea. Retained profit carried forward 170,000 Arsenal, 90,000 Chelsea. Additional information, given that the share capital of Arsenal stood at 200 million naira, and that of Chelsea amounted to 100 million naira, and the amount of non-controlling interest at acquisition as measured at fair value stood at 24 million naira. Required: prepare the consolidated profit or loss and the consolidated statement of changes in equity.
Thank you. We are required to prepare the consolidated statement of profit or loss and the consolidated statement of changes in equity. Now we can more or less copy that question and put it on our Excel templates. Okay, and this is what I've done now. Now, this is acquisition during the year. The year begins 1st of January 2016 and ended that's 1st December 2016. But 3 months after, at the end of 3 months, which is the beginning of the 4th month, we took over the control of Chelsea. And we become the parent of Chelsea, and Chelsea becomes the subsidiary of Arsenal. And the question then is, at what point do we start to consolidate the results? We start to consolidate the result of Chelsea from the date we took control of Chelsea, which was 1st of April 2016, whereas we are presented with the full year result of Chelsea. What then do we need to do? We need to be able to delineate the result of Chelsea into the results for the first 3 months, which is not part of our group, and the results after the first 3 months, which means the result for the remaining 9 months, which is when Chelsea was fully a member of our group. And in that case, we are only going to consolidate the income, the expenses of Chelsea from April 1st to 31st December 2016. Why? Because that was the period to which Chelsea became a member of the group. Okay, and that is a position there. Which then means that how do we now try to separate pre-acquisition items, income or expense, from post-acquisition item, income or expense? Now, one of those assumptions we're going to make, which is similar to what we made when we're preparing and presenting the consolidated statement of financial position, was to consider if revenue, expenses, and profit accrues evenly. Except otherwise stated, we assume that income and expense accrues evenly. Okay, and in this case, that's what we're going to assume, that revenue of January is not materially different from February. February not materially different from March up to December. Which then means that we can vividly, in this case, just consider a 9-month proration of income and expense line. And doing so, based on this, realize that the acquisition took effect 1st of April, and we are consolidating 31st of December. Therefore, all of these items we can find here, what do? We more or less consider the first 3 months, which I've canceled out here because it's not going to be consolidated. Whereas the remaining months between April, May to December are the period to which Chelsea is a part of the group, and which means we only consolidate 9 months, and that is the position here. And this is drawn from the premise that profits accrues evenly. Therefore, since we assume that profit accrues evenly, we are now prorating 9/12 as against any other methodology. Do you agree with that? That where, except otherwise stated, activities of a company is presumed to have accrued evenly, be it income or expense, which means invariably. Invariably, it affects profit, which means profit either will accrue or evenly. Okay. Let me bring that here as a fact. Okay, what then do we do? We need to recognize that though we have full year results of the subsidiary, but we are not going to consolidate the full year result of the subsidiary. What we are going to consolidate is the 9-month result of subsidiary beginning April to December. Therefore, the first thing is to acknowledge that I have full year result of both companies. But what then I will do is to convert the 12 months and take only the portion of 9 months, representing the period of April to December, which is this formula you can see here, 9/12 of whatever the full year result is. And this is done on the premise that profit accrues evenly on the basis of revenue and expenses. Therefore, I will go ahead and copy what I have here as a full year result of the two companies and present it in this my schedule. Okay, now I copy this and present it in my books, and therefore at that point I'm been able to produce 9-month results of it. Okay, now this is 9 months. If you can pick your calculator, 9/12 times 390 is what gives us that value. Similarly, 9/12 times 201 gives us this value, and all true. Therefore, what will I do? It means you must be very wary of the fact that this will no longer be relevant. This section of 12 months will no longer be relevant. Why? Because what is relevant now is the full year of the parent and the 9 months of the subsidiary, which means if you are to be in an exam, ensure that at every point in time, you rule out that aspect of the subsidiary 12 months so that you don't by mistake more or less consider it in the whole process, which means subject to adjustments. Which means subject to adjustment, it will be parent full year plus the subsidiary plus or minus group adjustment, which is what produced this. Since there's no intercompany transaction, therefore, in this case, it's just 600 plus 292 to give us a group revenue. It's just 345 plus 201 to give us, 345 plus 150 to give us 495,750, all through to the end. And that is the position there. Now, the next question then is, how do we attribute this 68,750? The whole of 50,000, which is the parent, goes to the parent. And now, as against 25, what we have for the 9 months is 18,750. The 18,750, remember, is a 9-month result that belongs to the parent and subsidiary and the non-controlling interest, which will now share in ratio 80 to 20. 80% of 18,750 is what we have as 15,000, and 20% of 18,750 is what we have as 3,750, and that's how we produce the results. And now, when we come here, our result is presented in a manner that suits our position here. Okay, and you can see revenue for the group is 892,500. Cost of sales is 495,750. Gross profit is 396,750. Distribution cost is 108,750. Administrative expenses is 172,500. Profit before tax is 115,500. Income tax expense is 46,750. And profit for the year is 68,750, which is attributed as follows. Owners of Arsenal, which is a parent, is 65,000 in thousands of naira, and non-controlling interest is 3,750 in thousands of naira. And that's the position. Now, again, to produce, remember, we already have 200,000 flowing from here, which is the share capital of the parent. I already have this 65 and 375 flowing from here. Now, what is left for us is to determine the retained earnings brought forward from a consolidation perspective and NCI brought forward. But we need to be painstaking here. Now, we need to ask ourselves, the subsidiary was acquired during the year. Therefore, since it was acquired during the year, okay, we have information that the pre-acquisition profits. You have information, there's no information about pre-acquisition profits. Okay. Now, therefore, no information about pre-acquisition profits. I'll just put question mark. Okay, subsidiaries retained earnings brought forward. Subsidiaries retained earnings brought forward is 65 million. Parents retained earnings brought forward is 120. And NCI was measured at acquisition at 24 million. Now, but one thing you need to take note is this. As at date of acquisition, okay, which was 1st of April, we acquired the subsidiary 1st of April, but we are talking of the retained earnings brought forward, which was as at 1st of January. 1st of January, 2010. No, sorry, 2016, yeah. As at 1st of January, 2016. It then means that we don't have Chelsea as our subsidiary as at that date. Therefore, in that situation, as at that date, when we are looking at this, as at this date, okay, I can tell you vividly that, let me put it in. Now, as at this date, Chelsea is not a subsidiary, okay? And if Chelsea is not a subsidiary as at this date, therefore, we have no participation in any of the reserve because all of the reserve as at that date will be pre-acquisition. Therefore, in this case, this will be nil. And if it is nil, it then means that the only thing that is there as consolidated retained earnings brought forward is that of the parent, which means when you add nil to 120, it's like adding 0 to 120, which means the entire value here is the 120 year. Okay, or because in any year of acquisition, the consolidated retained earnings brought forward will only be that of the parent. Take note of it. Why? Because as at that opening date, Chelsea is not a subsidiary. If you remember, Chelsea only became subsidiary 3 months after, or 4 months into the year. And that is it here. Okay, therefore, let's also look at it here. As at the same date here, let me copy the date. Now, as at the same date here, also, we still refer that Chelsea is not a subsidiary, okay, which means anything we have here is also nil as it is. It means the only thing we have, which we are going to make reference to, is Chelsea's, the value of non-controlling interest in Chelsea as at acquisition date. And let us emphasize the date. Acquisition took effect 1st of April 2016, which was 4 months after, or let me say 3 months after the year begins. Which that means that in this case, we have the sum of 24. Now this 24 is not an opening balance. You see where the 24 is reporting. It's reporting now, not as opening balance, because the opening balance is nil. Let me put it here, nil. The opening balance is nil, but it's reporting here as added on acquisition of Chelsea. What it means is that this is the first time we'll be recognizing NCI as equity within the group, which means it is only upon acquisition of a subsidiary that we are introducing non-controlling interest for the first time. And we introduce it by recognizing a credit to our equity, which will be described as added on acquisition of a subsidiary. And what is added on acquisition of subsidiary? The initial recognition of the value or amount of non-controlling interest in the subsidiary. And that is what we have recorded here as 24. And this 24 is what is coming here. And this is the last time you see added on acquisition, except we more or less acquire other subsidiary again, which has non-controlling interest, which is going forward, you will now be having opening balance of 27,750 for the next year, 2017. And that is that. But for the first year in which you acquire a subsidiary, the amount of non-controlling interest will not have been introduced as opening balance, but it will be introduced as what was added or created during that financial year, which we have seen here. And that is what we will now add to our share of profits and other comprehensive income to non-controlling interest. Therefore, this is for the first time how we introduce non-controlling interest in the year of acquisition. Any question on that? Any question on that? Okay, therefore, this is our full year results. Our income statement is presented where we only consolidated 9 months as against 12 months. Okay, and in this question, there are no intercompany transactions that will have triggered elimination vis-a-vis unrealized profit. Now we'll look at another question, probably. The question will also be acquisition during the year, but in this case, we want to ascertain whether transactions that occur between the parent and the subsidiary will have culminated into intercompany transaction if it occurred before acquisition or if it occurred after acquisition. Okay, let's go back to our material. Now let's look at illustration 16 and how that differs from illustration 15. Now, Mr. Denny, welcome back. We want to hear your voice. kindly assist us with this, illustration 16. Thank you, sir.
Good afternoon, sir. Illustration 16. Arsenal acquired 80% interest in the equity of Chelsea as 1st April 2016. The board of Arsenal strictly wants to comply with the requirement of IFRS regarding consolidation of the financial statements of the subsidiary with that of the parent as at December 31, 2016. Income statement for the year ended December 31, 2016. All figures are in 1,000 naira. Arsenal, Chelsea. Revenue, 600,000 for Arsenal, 390,000 for Chelsea. Cost of sales, 345,000 for Arsenal, 201,000 for Chelsea. Gross profit, 255,000 for Arsenal, 189,000 for Chelsea. Distribution cost, 75,000 for Arsenal, 45,000 for Chelsea. Administrative expenses, 105,000 for Arsenal, 90,000 for Chelsea. Profit or loss before tax, 75,000 for Arsenal, 54,000 for Chelsea. Income tax, 25,000 for Arsenal, 29,000 for Chelsea. Profit for the year, 50,000 for Arsenal, 25,000 for Chelsea. Movement in reserves, retained profit brought forward, 120,000 for Arsenal, 65,000 for Chelsea. Profit for the year, 50,000 for Arsenal, 25,000 for Chelsea. Retained profit carried forward, 170,000 for Arsenal, 90,000 for Chelsea. Additional information. It was obtained that on 19th May 2016, Arsenal already sold goods to Chelsea for 50 million naira when it actually cost Arsenal 40 million naira. As at the year end, included in the inventory of Chelsea PLC is 40% of the inventory sold by Arsenal PLC as of 19th May 2016. We are required to prepare the consolidated profit or loss and the consolidated statement of changes in equity, given that the share capital of Arsenal stood at 200 million and that of Chelsea amounted to 100 million, and the amount of NCI at acquisition as measured at fair value stood at 24 million naira.
Okay, thank you very much. Now let us now shift and copy the question to our spreadsheet. Now we have it here. Now it's the same question, but what is much more important for us to do now? But before then, let us do the same thing we've done before, which means let's copy the question exactly the way it is, but we'll take note that the 12 months of Chelsea will be converted to 9 months since the acquisition took place 4 months into the new year. Therefore, what do we have from this? The first year, Arsenal has revenue 600, Chelsea has 390, cost of sales 345, 201 respectively, gross profit 255, and 189 respectively, up to profit level of 50,000 and 25,000. Therefore, having copied that, we have this position, but remember we have to take off the 12 months and convert it to 9 months. Now, let's transaction that occurred between Arsenal and Chelsea. But we cannot, for now, quickly jump into a conclusion that it is an intercompany transaction. Intercompany transaction only occurs when a parent transacts with a subsidiary. Now, the question then is, as at the time the transaction took place, is Arsenal and Chelsea a member of the same group? Or simply put, is Arsenal the parent of Chelsea, or is Chelsea a subsidiary of Arsenal?
No.
The answer is yes. Therefore, it's intercompany transaction. Every requirement to eliminate intercompany transaction will be applied in full. But if the answer is no, which means the transaction occurred before Chelsea became a subsidiary of Arsenal, or Arsenal before Arsenal became a parent of Chelsea, such transaction will not constitute intercompany transaction. And in that regard, no elimination of intercompany transaction or whether our profit realized or not will take place, because I've done this transaction, or we have conducted this transaction even before we became family. You can say now. Therefore, that is the case. In this case, if you check the question, now we're told that it was obtained that on the 15th of March 2016, that was when the transaction took place. Therefore, in that manner, it means 15th of March 2016 predates 1st of April. Predates 1st of what? April 2016. Which means in that case, I can vividly tell you that there is no intercompany transaction. And if there's no intercompany transaction, there's no group adjustment, which means there's no adjustment other than combining the 12 months of the parent and the 9 months of the subsidiary, which means all of information we've done before remain the same. Which means everything we did here remain the same. And probably let me just copy and paste. Okay, and if that is the case, our results remain the same as when there was no even transaction at all because the transaction occurred 15th of March 2016, about 16 days before we even became a family. And therefore, such transaction is not an intercompany transaction. And our results remain the same as what we've done at this level. Any question? Now, later on, we'll look at what if the dates are different. What will happen? Any question? Any question?
Sorry, sir. Assuming there's information about the balance sheet, I want to believe that since it was 40%, the remaining 60%, there's going to be an adjustment kind of.
I didn't get you. What do you mean by
40% of the goods were sold before they now finally compensate them?
Adjustments. I'm saying that when transaction that you are referring to does not constitute intercompany transaction, therefore, which adjustment do you want to do? Nothing. because the transaction occurred before we became. That means you can swear a just transaction I did 5 years ago with somebody that today will now became husband and wife. Do you get what I'm saying now? But a transaction that occurred before now can create intercompany balance. It's different from intercompany transaction. Intercompany transaction is the value of what you exchange between you and the other party. But balance is what is still outstanding between you, having paid or received in part. Are you getting what I'm saying now? Which means if some of this value has not been fully paid and received by the end of the year or after acquisition, the balance there is intercompany balance, which can be eliminated in the balance sheet.
Okay.
But has no role to play in the profit or loss because it's a transaction that took place before you know yourself or before you become parent and subsidiary. Do you get what I'm saying now? Now let's look at a situation where in that similar manner, the date is no longer 15th March 2016, but the transaction occurred sometime after 1st of April. And let's look at that question. And we should look at,
sir,
yes. Yeah.
Sir, just a quick question, sir. If we are to consider the balances as intercompany, I mean, you know, with the answer you just gave to the last question. Yeah. So what happens then if part of the goods that we sold it still remains unsold? As you know, yes, sir.
It's not intercompany. The reason being that, okay, let me ask you, imagine the parents, sorry, before parent, Arsenal sold to Chelsea item about 3 years ago. And this year now, Chelsea becomes subsidiary of Arsenal. And the goods is still outstanding. Will you say it's intercompany goods such that it requires elimination of profit? No.
Okay, sir.
Anything you do before the marriage is outside wedlock, not inside wedlock. Do you get the logic?
Understood, sir.
Yeah. For example, in some countries where if a man divorces his wife, they share the property into two, I mean, for something like that. That is net of the liability. But when they want to share, they don't just share the wealth of the man. They will say, what was the value or the wealth of the man before marriage? If the wealth of the man before marriage is 1 billion, and today that they are divorcing, the wealth is now 3 billion. It means the marriage has only contributed 2 billion, and that's what they will share into two. Does that make sense? Do you get it, sir?
Yes, Prof. Thank you, sir.
Yeah. Which means any transaction consummated between an entity and the other before they became parent and subsidiary, such transaction will not constitute intercompany transaction. And any profit resulting in that transaction or loss has nothing to do with unrealized. But if settlement has not been fully made and there are still balances as at the time they are into the marriage, such constitutes intercompany balance. Intercompany balance, not intercompany transaction. You can see now. Balance is what is left after the transaction has been done and of which settlement has not been fully made. That is it. Now let's look at illustration 16. Okay, 15 deals with transaction occurring before acquisition, which is 15th of March. Let's look at 16. 16 is now occurring at 19th of May, whereas the acquisition is still 1st of April. Sir, can you continue with this illustration 16?
Okay, sir. Arsenal acquired 80% interest in the equity of Chelsea as 1 April as at 1 April 2016, the Board of ASNA strictly wants to comply with the requirements of IFRS regarding consolidation of the financial statement of the subsidiary with that of the parent as at December 31, 2016. Income statement for the year ended December 31, 2016, ASNA Chelsea, all figures in £1,000. Revenue 600,000 ASNA, 390,000 Chelsea. Cost of sales 345,000 ASNA, 201,000 Chelsea. Gross profit 255,000 ASNA, 189,000 Chelsea. Distribution cost 75,000 ASNA, 45,000 Chelsea. Administrative expenses 105,000 ASNA, 90,000 Chelsea. Profit or loss before tax 75,000 ASNA, 45,000 Chelsea. Income tax 25,000 ASNA, 29,000 Chelsea. Profit for the year 50,000 ASNA, 25,000 Chelsea. Movement in reserves. Retained profit brought forward 120,000 ASNA, 65,000 Chelsea. Profit for the year 50,000 ASNA, 25,000 Chelsea. Retained profit carried forward 170,000 ASNA, 90,000 Chelsea. Additional information. It was obtained that on 19th May 2016, ASNA already sold goods to Chelsea for 50 million naira when it actually cost ASNA 40 million naira. As at the year end, included in the inventory of Chelsea PLC is 40% of the inventory sold by ASNA PLC as of 19th May 2016. We are required to prepare the consolidated profit or loss and the consolidated statement of changes in equity, given that the share price of ASNA stood at 200 million naira and that of Chelsea amounted to 100 million naira. And the amount of NCI at acquisition as measured at fair value stood at 24 million naira.
Thank you. Thank you very much. Now,
Welcome,
we'll go to question there. Now, in this case, recall acquisition was 1st of April 2016, and the transaction was (19th of May 2016), which means the transaction occurred few days or 1 month, 19 days after the acquisition. Even if it's on the same date of acquisition or a day after, it is a transaction that was done post-acquisition. And any transaction done between a parent and subsidiary post-acquisition are considered intercompany transaction, which requires an adjustment in full, which means with or without we having the position be 12 months or not, we are going to make adjustment for the whole year. That's for the whole transaction. Why? Because, as you may know, the entire transaction here occurred after. But supposing we are giving information that this 50 million, the 50 million we have here, supposing we are giving information that this 50 million has certain components made in February and the other components made in June. Therefore, the amount and the cost of the one made in January, we exclude it from that made in June, so that that one made in January or February will not be adjusted for. We do as if it does not exist, so that the remaining balance that relates to June, be it revenue and cost, is what we now work on in full for necessary adjustment. Therefore, again, we have the 12-month period, 12-month subsidiary, but to convert the 12-month subsidiary into 9 months, assuming profit accrues evenly. 9 over 12 times 390 will give us 292,500. Likewise, cost of sales, distribution costs, admin expenses, income tax, so that our profit of 25 million for 12 months is equivalent of 9 months, 18.75 million. Now, there's intercompany transaction, which you now have to recognize because the transaction occurred after. And the first thing we need to take note is this. The transaction, what was the profit on intercompany transaction? The profit, in this case, who sold? Arsenal, the parents, sold to Chelsea. Therefore, we must take note of that. It sold at a value of 50 million. And what is sold for 50 million, Arsenal purchased it for 40 million, which means in that singular transaction, Arsenal has made 10 million. But we want to assess this 10 million, whether it is realized in full or unrealized in full, or partly realized and partly unrealized. But before then, we need to determine how to eliminate intercompany sales. Intercompany sales will be eliminated, as you can see, by reducing the sales revenue from the parent books and adjust for it appropriately in the inventory of the subsidiary. Okay, and that is the 50 million. And the effect of that is what you can see here immediately now, showing up. That the intercompany, the group revenue now is that of the parent, 12 months, and 9 months of the subsidiary, less the intercompany sales of 50. The next one is to eliminate the intercompany cost of sales. And to derive the intercompany cost of sales, it is the difference between intercompany sales, this 50, and the unrealized profits. Now, what is unrealized profit? Will come down here. Of this 10 million, what portion of it is unrealized? The portion unrealized is related to the unsold goods, of which the information given to us here says that as at the year end, included in the inventory of Chelsea, which means the unsold goods of the item purchased by Chelsea from Arsenal was 40%, which means if 40% of the goods were unsold, it then means 40% of this profit is deemed not to be realized by Arsenal, and therefore 40% of 10 million will give us 4 million. And this 4 million is simply the 40% multiplied by this 10 million. And that is what will flow up here as deduct the unrealized profits. Whatever you get after deducting unrealized profit from the intercompany sales revenue is your adjustment for cost of sales, which in this case will more or less credit to cost of sales. And remember, cost of sales is an expense. A credit to an expense account is a reduction of the value of the expense and a debit to inventory. Okay, net in the profit or loss, we are eliminating 4 million. Okay, and net in the inventory of subsidiary, you are also eliminating 4 million. And if you remember, as we eliminate in inventory those days, we eliminate unrealized what? Profit. And this is the approach to doing so, as you can see here. Now, invariably, we eliminate within our cost of sales, 46 million. If we have not done that, it will have been 345 plus 150, which will have given us 495,750. But because we eliminated 46,000 out of it, it gave us 449,750. And invariably, as you can see here, we eventually eliminated our profits. That's unrealized profits. Okay. Okay. Now, remember, these unrealized profits, who sold? Arsenal sold. That means that this unrealized profit is seated where? Is seated in this 50 million of the parent, because the parent made the 10 million, of which 4 million is unrealized, which means this 50 million is overstated. And what then do? We remove it. And that's why the entire unrealized profit on sale of goods by the parent to the subsidiary is totally eliminated against the parent. Remember our discussion yesterday. Okay, and that is that. And on that basis, we are able to attribute this 64,750 into 61 of the parent and 3,750 of the non-controlling interest. And automatically that flows here, 61 and 3,750. I remember our share capital of Arsenal is 200 million, which is here. Now, what then do we need to do? Similar thing we did the other time. Okay, we can go back there. Because it's acquisition during the year, okay, the position here still remains the same as we've explained it earlier. Okay, I just copy and paste it there. And that flows here as 120 and nil. But here is our added on what? Acquisition, which is the only thing we have taken into consideration here is that since the unrealized profit is attributed to sales transaction initiated by the parent, hence the whole of the unrealized profit will be deducted from the profit of the parent, and NCI is not affected, as you can see here. NCI is not affected in this situation. Okay, any question? Which means the difference between this and the other one is at what point did the transaction occur? Sometimes when you see some examination question, they will say, the parent sold goods to the subsidiary post combination or post acquisition, which means it was done after acquisition. In that case, it requires adjustments. But if they tell you that the transaction took place prior to acquisition, it shows that it is pre-acquisition transaction and such does not constitute intercompany transaction. Therefore, it will be ignored in totality. Does that make sense? Any question? If not, let us now look at what if our acquisition during the year resulted in a gain on bargain purchase, which means we acquire a subsidiary in that year, and this resulted in a gain arising from a bargain purchase transaction. Okay, and remember, what's a bargain purchase transaction? A transaction where the parent was able to offer value or consideration which is less than the obtained value of the net assets of the subsidiary as at the date of what? Acquisition. Now, can somebody more or less take us through this 8th principle, the media acquisition and the recognition of gain on bargain purchase?
Eighth principle, media acquisition and recognition of gain on bargain purchase. Illustration 17. Arsenal acquired 80% interest in the equity of Chelsea as 1st April 2016. The board of Arsenal strictly wants to comply with the requirements of IFRS regarding consolidation of the financial statements of the subsidiary with that of the parent as at December 31st, 2016. Income statement for the year ended December 31st, 2016. Arsenal, Chelsea. Revenue. All figures are in thousands of naira. Revenue for Arsenal, 600,000, for Chelsea, 390,000. Cost of sales, 345,000 for Arsenal, 201,000 naira for Chelsea. Gross profit sums 255,000 for Arsenal, and 189,000 for Chelsea. Distribution cost, 75,000 naira for Arsenal, 45,000 naira for Chelsea. Administrative expenses, 105,000 naira for Arsenal, 90,000 for Chelsea. Profit on before tax, 75,000 naira for Arsenal, 54,000 naira for Chelsea. Income tax, 25,000 naira for Arsenal, 29,000 naira for Chelsea. Profit for the year, 50,000 for Arsenal, and then 25,000 naira for Chelsea. Movements in reserve, retained profit brought forward, 120,000 for Arsenal, 65,000 for Chelsea. Profit for the year, 50,000 naira for Arsenal, 25,000 naira for Chelsea. Retained profits carried forward makes up 170,000 for Arsenal and 90,000 naira for Chelsea. Additional information required: prepare the consolidated statement of profit or loss and the consolidated statement of changes in equity, given that the share capital of Arsenal stood at 200 million naira and that of Chelsea amounted to 100 million naira, and the amount of non-controlling interest at acquisition as measured at fair value stood at 24 million naira. On acquisition of the subsidiary, there was a gain on bargain purchase of 3 million naira, which is yet to be recognized.
Okay, thank you. Okay, now let's look at it. Now, this information is just right. Now, in this case, it's equally an acquisition during the year. And they've even gone ahead to determine our gain on bargain purchase, which is what we are only meant to do ourselves, is how do we report that gain on bargain purchase. But because it's acquisition during the year, we still take that cognizance to ensure that we prorate the 12-month result of the subsidiary into 9 months, assuming revenue, income, expenses, all accrues what? Evenly. Okay. Now, that is that. Now, on this premise, we have this position here. But you remember that we don't have other income in the individual accounts before, but we are now creating other income now as a result of gain arising from bargain purchase transaction. And we are told here that the gain from bargain purchase transaction was 3 million. On acquisition of the subsidiary, there was a gain on bargain purchase transaction of 3 million, which is yet to be recognized. Therefore, on that premise, what then do we do? What we need to do is to recognize it as an adjustment. But in practical sense, you should also know how to determine that. And how do you determine that? You compare the fair value of the consideration, reflecting that of the parent and non-controlling interest, and you compare it to the fair value of the net asset acquired. If it becomes negative goodwill, we treat it as a gain upon realization that the amount is valid. And we said earlier that the entire gain is solely attributed to the parent because NCI was not a party to the transaction. Rather, it was only the parent that is a party to the transaction. Therefore, how do I recognize the gain? I recognize it as an adjustment to other income. And therefore, I recognize the 3 million, or figure in thousands. Now that invariably increases the group profits. Okay, now how do we treat it? Remember, initially, the 50 million belongs to the parents. Initially, rather than 25, the 18,750, which is the 9 months, is prorated in ratio 80-20 to 15 and 375. Now, the 3 million, that is an adjustment to it now, is going to be reported only in the books of the parent, or because it's the parent that made that gain. with or without your accounting methodology towards measuring NCI, either at proportionate share of the identifiable net asset at acquisition date or at the acquisition date fair value of the equity instruments, you attribute the entire gain arising from a bargain purchase transaction to the parent, which means this entire gain arising from bargain purchase goes to the parent only. And on that premise, we are able to say the profit for the year attributable to the parent is 68 million. And that to NCI, non-controlling interest, is 3,750,000 naira. And that's what you can see here, whereby we are introducing this 3 million as a gain arising on bargain purchase transaction on acquisition of the subsidiary in that year. Any question? Any question? Now, invariably here,
Okay.
And 3750 are flowing here. Now, remember again, as I have said, because it's acquisition during the year, we still come to the position will still not change about the impact that at the beginning of the year, there's no amount for non-controlling interest. Okay, all because Chelsea was not our subsidiary as at the beginning of that year. And likewise, our consolidated retained earnings does not exist other than the retained earnings of the parent brought forward as at the beginning of the year, since we have no subsidiary as at that point in time, which means, as I said earlier, this is nil. Let me write it there, nil, for information, nil. Nil. And you can see that this is always going to be 0 or nil, since Chelsea was here to be a subsidiary as at 31st of December 2015 or 1st of January 2016. And that is the position here. Yeah. Any question? Now, let me quickly go back to illustration 16. In illustration 16, it was post-acquisition transaction, which means the transaction occurred after acquisition, and it was Arsenal that sold to Chelsea. Okay, that is the original question. Now, I try to modify the question. Now, what if Chelsea sold to Arsenal? What would have been the position? Now, if you come here, I'll change the question as thus. I want to change the question. And let's assume the transaction occurred when it was Chelsea that sold to Arsenal. Now, I've more or less changed it. Now, if you can read the question here, it was obtained that on 19th of May, 2016, Chelsea already sold goods to Arsenal for 50 million, when it actually cost Chelsea 40 million. As at the year end, included in the inventory of Arsenal PLC is 40% of the inventory sold by Chelsea, which means I just tried to paint it and change the question so that it was Chelsea that is selling. Now, this will not change virtually most of what we've done. Okay? It's not going to change virtually most of what we've done. but you see where the difference sets in. Okay, we'll copy all of this information here. I will try and paste it. Sorry. I've copied wrongly. Sorry. Now I copy this. Now, remember again, we take the 12 month and convert it to 9 months. Now, what has happened? There's intercompany sale of goods because it occurred after acquisition. And therefore, 50 million was the revenue. But what Chelsea sold for 50 million, Chelsea bought it for 40 million, which means Chelsea made 10 million. But we are told that included in event, which means part of what Chelsea sold to Arsenal was unable to sell it or to Chelsea to this customer. Now, what percentage has not been sold by Arsenal? 40%. Now that means that 40% of that 10 million is going to be unrealized. Therefore, I can now come here and say intercompany sales is the 50 million less the unrealized profit, which means my intercompany cost of sales adjustment is 46. Now I have to eliminate intercompany sales, and also I have to eliminate intercompany cost of sales. And doing so, you can see what it produced. Okay, which is still not different from what we have here. But what will only be the difference is how do we treat? Here, unrealized profit was eliminated in full against the period. What then we would do at this point here? What we do at this point here is a function of the fact that who sold Chelsea? Now, Chelsea sold to Arsenal. It then means this 4 million that is unrealized is seated where? It's seated in this 18,750. And we have already distributed 18,750 in the ratio of 15,000 and 3,750. Therefore, the same ratio we have used to appropriate this profit, we also use to reappropriate this deduction, which is ratio 80-20. And 80% of the 4 million, this 4 million, which you can see here, of this 4 million, is what gave this 3.2 million. And 20% of the same 4 million that gave this 800,000. And that's the difference in the methodology, which means the same 64,750 is now attributed as 61,800 and 2,950 as against before, which was 61,000 and 3,750. Now, if you come down here, what is our result? This is our result. And the same thing flows here to profit for the year and NCI's own share portion. Now, but again, as you all know, our share capital of Arsenal is 200 million, or figure in thousands here. Now, how do we deal with this? Remember, this will always be nil. Why is it nil? As I said earlier, it is nil because of the fact that NCI, or sorry, the subsidiary was not in existence as at that date. Okay? And therefore, what's our consolidated retaining earnings for? It will be only restricted to that of, if I can just copy it, restricted to that of the parents, because the subsidiary was not in existence as our subsidiary as at the beginning of this year. And that is the position, which means the same thing still resurfaces itself The retained earnings is only that of the parent because this is nil. And SCI was nil because we don't have subsidiaries at that beginning. Therefore, we don't have other shareholders in that subsidiary because we are not part of it until when we introduce the subsidiary and equally introduce the equity of others in the subsidiary as 24. And during this year, for the 9 months result, they are able to participate in our profits, which is a profit of subsidiary to the extent of 2,950,000. Okay, and that is the position there. Any question? Any question? Okay, now we also look at what if we start to have other comprehensive what? Income. If you have other comprehensive income, which means everything we have been doing before now is profit or loss. What if we have other comprehensive income, such as gain on revaluation, such as fair value reserve, such as cash flow hedge reserve, such as actuarial gain reserve, and etc. How do we do it? It's not a big deal. Exactly the way we did for items of income statement is the same way we are going to do for such item that will consider other comprehensive income. Now, on this premise, I think let's look at illustration 18, where we'll be introduced for the first time into financial statement of the parent and subsidiary where we have other comprehensive income. Okay, Mr. Denny, I wish you help us to read. Thank you.
Okay, illustration 18. As now acquire 80% of interest in equity verse 2014 when it was incorporated.
Chalisa, your network is breaking and there's a noise at all.
Okay.
I didn't hear it.
Someone else can read, please.
Mr. Dini, are you there? Or Janet, can you read?
Illustration 18. Asna acquired 80% interest in the equity of Chelsea as January 1st, 2014. When it was incorporated, the board of Asna strictly wants to comply with the requirements of IFRS regarding consolidation of the financial statement of the subsidiary with that of the parent as December 31st, 2016. Income statement for the year ended December 31st, 2016, Asna Chelsea. All figures in £1,000. Revenue 600,000, 390,000, Asna and Chelsea. Cost of sales 345,000, 201,000, Asna and Chelsea. Gross profit 255,000, 189,000, Asna and Chelsea respectively. Distribution cost 75,000, Asna 45,000, Chelsea. Administrative expenses 105,000, Asna 90,000, Chelsea. Profit on before tax 75,000, Asna 54,000, Chelsea. Income tax 25,000, Asna 29,000, Chelsea. Profit on before tax 25,000, Asna 54,000, Chelsea. Income tax 25,000, Asna 29,000, Chelsea. Profit for the year 50,000, Asna 25,000, Chelsea. Other comprehensive income, fair value gains or loss on financial assets at fair value of comprehensive income. I'm not sure. FVOCI 10,000, Asna Chelsea 3,000. Evaluation surplus of property, plant and equipment 4,000, Asna Chelsea 2,000. Total comprehensive income 44,000, Asna 30,000, Chelsea. Movement in retained earnings. Retained profit brought forward 120,000 Arsenal, 65,000 Chelsea. Profit for the year 50,000 Arsenal, 25,000 Chelsea. Retained profit carried forward 170,000 Arsenal, 90,000 Chelsea. Movement in other components of equity. Other reserve brought forward 38,000 Arsenal, 44,000 Chelsea. Other comprehensive income for the year 6,000 Arsenal, 5,000 Chelsea. Other reserves carried forward 32,000 Arsenal, 9,000 Chelsea. Required. Prepare the consolidated profit or loss and the consolidated statements of changes in equity, given that the share capital of Arsenal stood at 200 million naira and that of Chelsea amounted to 100 million naira, and the amount of non-controlling interest at acquisition as measured at proportionate of net assets share stood at 20 million naira. In this context of this text, we will approach a step-by-step approach to explaining the requirements of IFRS 10 with regards to consolidating the financial results of the parent and the subsidiary as depicted below.
Okay, thank you very much. Thank you very much. Now we've had the question, and now you can see that in our results we've added section such as this section for other comprehensive income in order to aggregate with it our profit for the year to get our total comprehensive income. And in similar vein, as we attribute this profit for the year into that of the owners of Arsenal, we also attribute the total comprehensive income into that of Arsenal and also NCI. Okay, and we're going to see that. Now let's go back to our consolidation schedule. Okay, now this our schedule is plain as it is, therefore we copy all information here. Now we will not stop at profit or loss, we copy it up to total comprehensive income. And doing so, we have this. Now there's no adjustment yet. Now in this question, there are no intercompany transactions, which means there's no adjustment required for now. Now the first thing we'll do is this. Since there's no adjustment required, every activity we do will stop at profit for the year. Now, profit for the year of the parent is 50, which is what you bring here. Now, the profit for the year for the subsidiary is 25. Remember, we acquired the subsidiary about 2 or 3 years ago. Therefore, this is not having anything to do with acquisition during the year. Now, this 25, we attribute it to the ratio 80-20, which gives 20,000 to the parent and 5,000 to the NCI. Okay, now that is that. In that vein, we are able to produce a profit or loss and how we attribute the profit or loss. But now we have other comprehensive income. The first item being the fair value gain or loss on financial assets measured at fair value through other comprehensive income, which we call FVOCI. Okay, for the parent, it has a fair value loss. That's why it's negative. Okay, let me put loss in negative, which is red, so that you can see this is a loss. The parent had a loss, but the subsidiary had a gain. Now, evaluation surplus. Both the subsidiary has gain of 4,000 due to the parent and 2,000 of subsidiary. Therefore, the question then is, how do we consolidate this? We also consolidate it line by line. The loss of the parent in the fair value plus the gain of the subsidiary will give net loss for the group of 7,000. The gain on evaluation for the parent, which is 4, plus the gain on evaluation for the subsidiary, which is 2, will give us combined 6 million for the group, which means the other comprehensive income for the group net is negative. Why? We have more of fair value loss arising from the parent than more of revaluation gain. arising from both, which means net of this is negative 7, which means our profit or loss for the year is greater than total comprehensive income because of this net loss position from other comprehensive income. And this is solely attributed to massive fair value loss by the parents. And that's that. Okay. Now, how do we now attribute this? In similar way, we come down, we say, first, total comprehensive income attribution, we always start from the profit or loss. Remember, because the profit or loss plus other comprehensive income is what gives total comprehensive income. If you can check here, you can see that is this highlighted blue and highlighted amber give us the 44. And likewise, the highlighted blue and amber give us 30. In that case, we'll first of all bring in our profit attribution. The parent profit attribution is 70 out of 74, so out of 75. And the subsidiary, NCI is what? 5,000 out of 75, which means when you check the total here, I can more or less bring total here. And just create total. And I can see my total is 100% when I add these two together. Okay, which means I can total everything so that I can see what we are trying to do. Okay. Okay, now the only new thing is now this other comprehensive income item. Let me pick them one by one. Let me pick the fair value loss from the parent, 10. NCI has no business in this loss of the parent. Even if it's gain, it has no business because it is the activity of the parent as a standalone entity. Therefore, the entire loss will come to the parent. Whereas the gain or loss on that fair value to the subsidiary, in this case is a gain, of subsidiary belongs to the shareholders of subsidiary. And what shareholders? The parent, 80%, NCI 20%. Therefore, I share that 80% of that 3 goes to the parent. 20% of that 3 goes to the NCI. Also for evaluation, the entire evaluation gain of the parent as a standalone entity goes to the parent. Whereas the gain on evaluation of subsidiary goes to the shareholders, which means 80% goes to the parent and 20% goes to the subsidiary. And that's how we share it. Invariably, we have been able to attribute it. Therefore, when you check it in all, what goes to the parent, all in all, is 68. What goes to NCI, all in all, is 6,000. And when you add it together, it's now 74,000. And therefore, we are able to produce the results in this manner, which means this 75 is this attribution, and this 74 is this attribution. Does that make sense? And if there's any question, please kindly ask. Look at it again, the way we've done it. Any question on that? If your background noise is still there, you can send a chat. If not, now that is that. Now, let's go back. I can see that here. The profit or loss 75 was linked here. Why the other comprehensive income You can see 76 for the fair value gain and 600. When you add the two together, it's 7,000. How do we do that? Remember, the parent on the standalone has 10,000 plus the share of the subsidiary. When you add these two together, it is 76 negative, which is what you have here. Okay, the parent the subsidiary NCI only has 600. That's the positive 600 you have here. When you come to evaluation surplus, the parent on the standalone is 4,000, and the share in subsidiary is 16. When you add the two, it's this positive 56. And when you look on the standalone for the NCI 400, that's the 400, and that's just all. And invariably, we are able to produce our results in this manner. Any question? Now, let's check our opening balance again. Pre-acquisition retained earnings were given here that Arsenal acquired 80% interest in Chelsea on January 1st, 2014 when it was incorporated. It means every pre-acquisition retained earnings is zero, including pre-acquisition other component of equity. Because remember, we have other component of equity, which we are told. And other component of equity will have arose from fair value reserve, valuation gain, and etc. Now, subsidiaries retained earnings brought forward, okay, is 65, and its other component of equity brought forward is 4,000. Therefore, we'll come here and say this is 65, all figure in thousands, and this is 4,000. If I don't miss it, all figure in thousands. Let me copy this and put it here. All figure in thousands. Okay. Now, what is parent retained profit? It's 120 brought forward, and it's 38 for other component of equity brought forward. 120 and 38. 120 and 38. And NCI was measured at acquisition date at net asset value, which was estimated at 20 million. Therefore, come here, 20 million, now controlling interest at acquisition date. That's 24 million. Okay, therefore we start. Parent retained earnings brought forward. We already have it as 120. Now, remember, here, we need to determine this, similar to what we've done before. If you remember, this is what we needed. We needed the post-acquisition retained profit brought forward. Now, which means the post-acquisition retained earnings brought forward is the difference between the subsidiary retained earnings brought forward and pre-acquisition. And since we acquired the subsidiary at incorporation, the entire reserve was zero as at acquisition. Therefore, the 65 minus 0 will still give you 65. Okay, similarly, we'll do the same thing for other component of equity, which what is brought forward for the subsidiary is 4 million. And as at acquisition, since its incorporation date is 0, which means I'll just say post-acquisition OCI now. Okay, OCI. Now, that is that. Now, I pick it. The consolidated retained earnings brought forward is the retained earnings of the parent, 120, plus 80% share by the parent in the post-acquisition retained earnings of the subsidiary brought forward, which is, we've already determined the post-acquisition brought forward at 65, 80% of 65. Where's that 80% flowing from? From here, 80% of our 65 here will give us this, and this gives us 172, which flows in here, as you can see it here. Now, similarly, we do for NCI. The value of NCI as at acquisition was said to be 20. Is it 20 or 24? 20. How come I wrote 24? Therefore, let me change it, 20. Okay. Now, NCI has share of post-acquisition profit, which is the 65. Remember, we have taken 80%, we are giving it to the parent. The 20% will give it to the subsidiary. Therefore, 20% 20% of the 65, which is 13. Now, also, we come back to the other comprehensive income. The other comprehensive income brought forward for the parent is 38. Therefore, I come here. Other component of equity brought forward for the parent is 38. Okay. Now, the parent will equally share 80% post-acquisition other component of equity brought forward for the subsidiary, which means the 80% of the post-acquisition brought forward, which is 4 million here, okay, is 3,200. And this 41,200 in total now is reflected here under other component of equity as the opening balance. Now, my NCI also takes the balance of 20%. Okay, but NCI is just a single account, which means everything goes into a single account for non-controlling interest. And in that case, the 20%, which is what is left after taking 80% of this to the parent, will also be recognized. 20% of the post-acquisition other component of equity of the subsidiary, which is 4 million, will also be shared to the non-controlling interest, which means invariably the opening balance for NCI is 33,800, which is what is reflected here. At the end of the day, when you cast all of this, all things being equal, you should be able to obtain all of this value in that case. Which means here we have been able to demonstrate to you how do you consolidate both profit or loss and other comprehensive income. Okay, and not only that, how do you attribute both the profit and other comprehensive income to the parent and the non-controlling interest in a systemic and chronological order, and how that also flows to recognizing separately the consolidated retained earnings brought forward for the parent and also the consolidated other component of equity brought forward for the parent as against the opening balance for the non-controlling interest for the other investors in the subsidiary. Any other question in this case? Any other question? Any other question? Okay. Any other question? Okay. Now let's look at how do you treat impairment loss on goodwill in the income statement. How do we treat impairment loss on goodwill in the income statement? Okay, Mr. Dini, are you back? If you are back, can you help us with impairment loss on goodwill? Okay, Janet, can you read for us, please?
Impairment on loss on goodwill. Illustration 19. Asna acquired 80% interest in the equity of Chelsea as January 1st, 2010, when the retained earnings stood at 20 million naira. The board of Arsenal strictly wants to comply with the requirements of IFRS regarding consolidation of the financial statements of the subsidiary with that of the parent as at December 31st, 2016. Income statement from the year ended December 31, 2016. Arsenal, Chelsea, all figures in thousand naira. Revenue 600,000 Arsenal, 390,000 Chelsea. Cost of sales 345,000 Arsenal, 201,000 Chelsea. Gross profit 255,000 Arsenal, 189,000 Chelsea. Distribution cost 75,000 Arsenal, 45,000 Chelsea. Administrative expenses, 105,000 Asna, 90,000 Chelsea. Profit on before tax, 105,000 Asna, 90,000 Chelsea. Profit on before tax, and 5,000 Asna, 54,000 Chelsea. Profit on before tax, profit on before tax, 75,000 Asna, 54,000 Chelsea. Income tax, 25,000 Asna, 29,000 Chelsea. Profit for the year, 25,000 Asna, 29,000 Chelsea. Profit for the year, 50,000 Asna, 25,000 Chelsea. Movement in reserves, retained profit brought forward, 120,000 Asna, 65,000 Chelsea. Profit for the year, 50,000 Asna, 25,000 Chelsea. Retained profit carried forward, 170,000 Asna, 90,000 Chelsea. Required, prepare the consolidated profit or loss and consolidated statement of changes in equity, given that the share capital of Arsenal stood at 20 million naira and that of Chelsea amounted to 100 million naira, and the amount of non-controlling interest at acquisition as measured at fair value stood at 24 million naira. As at the reporting date 31st December 2016, the goodwill has been impaired to the tune of 12 million naira, and of which only 5 million naira represent the impairment loss attributable to 2016 financial year.
Thank you very much. Thank you very much. Now, as you can check here, you'll find out that the only thing that is new here is that there was an impairment. Cumulative impairments that has occurred since acquisition. This company was acquired in 2010, and the reserve then was 20 million. Since then, till date, goodwill has been impaired to the tune of 12 million naira. But remember, you are not going to report the cumulative goodwill impairment loss from dates of inception to today in your profit or loss, because your profit or loss is only reflecting that of a period, which is this year. Which means you must be able to know what portion of that 12 million relates to impairment loss this year, and which we are told that it is 5 million. Which means if 5 million is the impairment loss on goodwill for this year, it means between 2010 and 2015, the effect of impairment loss will have been 7 million. I'm not bothered whether it's the 7 million only happened in 2015, or only happened in 2014, or 13, 12, 10, or it happens over the period. What happened is that everything between 2010 and 2015 sum up to 7 million. Why the impairment loss for this year alone is 5 million. Which then means that the total impairment loss on my goodwill is 12 million. Now, for my profit or loss, I only recognize impact for the current year. Why for my statement in consolidated statement of change in equity, especially with respect to the balance brought forward, I must recognize that the cumulative effect of 7 million will have reduced my profit over the last 5 years, which means my retained earnings will have been affected by that 7 million, regardless of when it occurred, or because impairment loss is a charge on profit. And the more you charge on profit, the lower your retained earnings will be cumulatively in the prior periods. Which then means that the effect of this should have been reflected from the group perspective in my opening balance. But again, since they didn't give me my group opening balance, they only gave me opening balances with respect to retained earnings for the parent and subsidiaries separately. And now I will now wear my thinking cap as a group accountant to know what will have been the effect of prior period impairment loss on goodwill on my consolidated retained earnings brought forward. And we're going to see all of this in our discussion. But as we move on, the first thing we need to do is to ensure that we copy all of the information given to us in our income statement the way it is. We copy them and paste them in our appropriate section in our consolidation schedule. Therefore, this is my consolidation schedule. I copy it and I paste. Okay, doing so, I have this position. Now, I was told that there's an impairment loss, which means I need to more or less analyze this impairment loss into two. Okay, to do that, I create a working, which means the treatment of my impairment loss on goodwill is a function of which period it relates to. Which that means that the first thing I do is that the cumulative balance was set to be 12 million, of which I was told that 5 million of it relates to the current year. Be careful. Examiner might twist this and say 7 million of it relates to prior periods, which means you need to just understand the language given to you. Which means if 5 out of 12 relates to this period, it then means that the remaining balance, which means the difference between 12 and 5, will relate to prior periods, which means periods between acquisition. Acquisition was 1st of January 2010 up to 31st of December 2015. Is when this 7 million was recorded or recognized. Okay, which that means that for the current period, how do I treat impairment loss? I treat impairment loss as a charge to the subsidiary's profit, which usually goes within administrative expenses, and I'll credit my goodwill. Okay, now how do I know that my goodwill is full goodwill here? Who can tell me why the goodwill is full goodwill? How do you know that it's a full goodwill when we are not expressly told? How do you know? Is it that you just assume or what? How do you know it's a full goodwill? I'm waiting. So you can send a chat if there's background noise. How do you know it's full goodwill?
I have no idea.
Okay. Have you forgotten the information here? And that's why we need to pay more attention here. They said the amount of non-controlling interest at acquisition is measured at what? Fair what? Value. And if you go back to all our discussion prior to now, we have two methodologies to measure non-controlling interest. The first one is the proportionate share of the identifiable net asset, while the second one is fair value of the equity instrument. And we have reached a conclusion then that peradventure we measure NCI at proportionate share. What we always resort to when there's a goodwill is a partial goodwill. Otherwise, when is a fair value measurement, what we'll have recognized is a full goodwill. And that's where it's coming from. Please take note of it. Take note of it. Why this is full goodwill. Take note, please. Okay. Now that is that. What that means that the impact of this full goodwill is that the entire loss will be borne by both the parent and the non-controlling interest, because a full goodwill recognizes goodwill contribution of both the parent and the non-controlling interest, which means we've recognized this 5 million as a deduction, which means it increases our administrative expense. And anything that increases our administrative expense is a deduction or additional deduction from our profits, which means invariably in this case, we are deducting additional 5 million from our profit or loss. Okay, now invariably, instead of our expense that's going to be 195, it's now 200 because of the additional charge. Now, that now reduces our profit to 70 from the group perspective. But here, the 50 has been reported here as solely for the parent. And this 25 here has been shared between the parent and the NCI in the proportion they share profit or loss 80-20. Okay, now we then need to share this loss, 5 million. We are sharing this loss because it is impairment loss on full goodwill. If it's on partial goodwill, since we only recognize the goodwill attributed by the parent and it has been impaired, in that case, it will only be for the parent. But in this case, we have recognized goodwill in full, whereby recognizing the goodwill contributed by both the parent and the non-controlling interest. Therefore, it will be appropriate for us also to share this loss in the same proportion. 80% of it to the parent and 20% of it to the subsidiary. And in this case, it produces 66 and 4 as the position is. And that is that. Therefore, if you come here, you have our position here. The admin expenses increased to 200, and we are able to produce the attribution of the profit in this manner, which already flows into here as 66 and 4. Now, let us go back here. Information here, as at acquisition, the retained earnings was 20. Subsidiary retained earning brought forward was 65. Parent retained earning brought forward was 120. Non-controlling interest at acquisition was 24 million. Okay, therefore, parent retained earning brought forward 120, and the 80%, how we got this is very simple. Okay, now how we got this is this. If you go back here, our post-acquisition retained earning brought forward is the difference between the pre-acquisition brought forward, sorry, the subsidiary retained earning brought forward and the pre-acquisition. 65 minus 20 will give us 45. Now, but when you apply 80% on 45, you don't get what we had before. Why? Because in that manner, we have not deducted the impairment loss on goodwill, which means when we deduct impairment loss on goodwill, what will happen in that manner is that we will more or less get what it's supposed to be, which means in that case, I'll come here and say the impairment loss on goodwill in the prior year, what was it? Remember, 5,000 was current year, but this 7,000 will have affected our opening balance because it will have been deducted in the prior year, which means prior year impairment loss up to 31st December 2015 will have been charged to various profit or loss in those periods, which will have closer to retained earnings. And in that light, it will have reduced the retained earnings by 7.5, which means As we have charged 5,000 to our current year profit, we'll charge the 7,000 to retain earnings brought forward for the subsidiary, which means the subsidiary retained earnings brought forward should have been lower than this 65 if we have recognized the impairment loss of 7 million. Which then means that I have to come here and say, this is before impairment, post-acquisition profit, before what? Prior period impairment losses. Now, if that is the case, okay, prior period impairment losses. Now, if that is the case, I need to deduct the impairment loss for prior years. And what is the impairment loss of prior years? Impairment loss of prior years is 7 million. When you remove 7 million from 45,000, let me say, for example, 45,000 minus 7 million will give me 38. Which that means that technically, if I share 80% of that 38, what is left? 3,400. But what I have here is 36. Why? Because I've only shared 80% of this 45 without considering the 7 million, which means I can come here in my formula to say 80% of 45 minus this 7 million. And once I do that, it gives me the same amount. Okay, just take notes. I can put this in what column? Okay. Take note of this in case you have your spreadsheet, and take note of it here. And take note of it here. Okay. That is that. Okay. Similarly, everything I've done here, remember, NCI is 24 at acquisition. The same expression I've done here is what I'll repeat here, which means if you now take NCI portion will be 20% of 38, and that will be 7.6. How do you get this 7.6? You see the 20% here, multiplied by open bracket 45 minus the 7 million. $45 minus the 7 million. So, that's 7.6. Okay, at the end of the day, 150, 400. Let me also put the pin there. $150, 400. We go on to the opening consolidated retained earnings for the parents, and 31,600 will be the opening balance for the non-controlling interest. And this is anything, not only on goodwill, impairment on goodwill, anything that affects prior year consolidation. Okay, we always be adjusted for in case you don't have the consolidated retained earnings last year. If you have to prepare it yourself, you only have information about the parents retained earnings brought forward, and you have information about the subsidiary retained earnings brought forward. You must always adjust for any impact of transaction or events that occurred in the prior year, so that you are doing it as if that was the last year account you are preparing, each of those transactions will have impacted the profits, and therefore your retained earnings consolidated will have been in a lower position or higher position, regardless of the way it is. Which that means that we are more or less mimicking what you will have done last year to produce consolidated reports, which will be rolled over to this year. And that's what we're trying to do here. Okay, take note. The same thing will affect when you have depreciation adjustment. Imagine you measure assets at fair value, plant, for example, at fair value 2 years ago when we acquired the subsidiary. Now you are not preparing income statement today. The depreciation effect of that fair value adjustment in the last 2 years will have impacted the retained earnings up to the end of last year. Which that means that in this year, when you have to obtain that retained earnings, consolidated retained earnings brought forward, if you are not expressly given, and you now want to work from the retained earnings brought forward of the parent and subsidiary, you must ensure all of those adjustments that will have impacted group profit, then you effect it on the consolidated opening retained earnings in order to show what the two positions will have been, assuming you have been doing it on a year-on-year basis. We are still going to see more of this as it relates to prior year effect of transactions that require elimination or adjustment. Okay, that is that now. What have we done? The current year portion is what we adjusted for in our profit or loss, while the prior year aspect of it, we adjust it against the consolidated retained earnings brought forward and also the non-controlling interest. Any other question? Any other question? Now, again, we look at the same question, but in this case, we measure the non-controlling interest at the proportionate share of the identifiable net assets. And in that case, we measure it so that any goodwill that arose will have been partial goodwill. And if it's partial goodwill, will it have effect on non-controlling interest? Therefore, we look at illustration 20. We look at illustration 20. Now, can somebody read illustration 20 for us? Provided you don't have a noise in your background. Okay, illustration 20, who will volunteer? Who will volunteer? I'm still waiting. Okay. Can somebody read without a noise background? Janet, if you have no noise background, can you read, please?
I have a noisy background here, sir. I have a noisy background.
Okay, don't bother to read. Is Mr. Denny there? Can you read? Is Janet there? Esther, do you have a less noisy background?
The background is noisy.
Okay, I think I will take the action to read in that case. Okay, Asna acquired 80% interest in the equity of Chelsea as of January 1, 2010, when the retained earnings stood at 20 million. The board of Asna strictly want to comply with the requirement of IFRS regarding consolidation. of the financial statement of the subsidiary with that of the parent as at 31st December 2016. We are given the income statements for the year ended 31st December 2016, and we have both Arsenal and Chelsea. And if you checked, we are given revenue, cost of sales, gross profit, distribution costs, admin expenses, profit before tax, income tax expense, profit for the year, which stood at 50 million and 25 million respectively. Movement in reserves, we have the retained earnings brought forward, we have the profit for the year, and we have the retained earnings carried forward. The requirement was that we should prepare the consolidated statement of profit or loss and the consolidated statement of changes in equity, given that the share capital of Arsenal stood at 200 million naira and that of Chelsea amounted to 130 million naira. And the amount of non-controlling interest at acquisition was measured at the proportionate share of the subsidiary's identifiable net assets, which amounted to 30 million naira. As at the reporting date, which was 31st December 2016, the goodwill had been impaired to the tune of 12 million naira, and of which only 5 million represent impairment loss attributable to 2016 financial year. Okay, now what is critical here, as you can see, is that non-controlling interest was rather measured as proportionate share of the identifiable net assets, which amounted to 30 million. Therefore, we need to take note of that. And in doing so, what then do we need to do? Let's go back to our spreadsheet. Now, again, we copy the information given to us with respect to income statement. I think it's not materially different from what we have there. Therefore, we copy that and we paste it. Okay, we've done what we need to do, like our normal practice. Okay, therefore, we've distributed all of this, except for the fact that we're told that we have the cumulative impairment loss to be 12, of which 5 million was for the current year, resulting in 7 million for prior periods. And therefore, the subsidiary's profit is reduced by 5 million, which will pass as a way of adjustment. Yeah. And because this is a partial goodwill, the entire impairment loss on a partial goodwill will be solely attributed to the parent, regardless of the fact that the parent owns 80%, or because this impairment assessment was strictly on top of the goodwill recognized solely by the parent, which is partial, not the full goodwill, or because the goodwill contribution recognized in this case was that of the parent only, which means in this case, unlike the other case where we share it because it's full goodwill, in this case, we only recognize it 100% to the parent because the goodwill so impacted is that of the parent. And remember, go back to our discussion in the balance sheet aspect of the consolidation where we make extensive revelation of that. Now, in that case, that produces this account for us, and we're able to attribute this profit of 70 to the parent, 65, and non-controlling interest, 5. Now, similarly, the remaining 7,000 will be adjusted against the opening retained earnings, which is this, and we're going to see the effect there. But before then, remember, we add our information relating to pre-acquisition reserve to be 20 million, subsidiaries the subsidiary's profit brought forward is 65. The parent profit brought forward is 120, and the non-controlling interest is 30. Therefore, we come here and put everything there, which is 30. Okay, which is 30. Now, everything is there. In this case, what happens? We come back to say the consolidated retained earnings brought forward is that of the parent, 120. Now, we are going to share 80%, as I have said earlier. 80% of what? Remember what we did here? Before impairment loss, what we have was 45. Okay? What we have was 45, which is 65 minus 20. And remember, the impairment loss cumulatively as at last year was 7 million, which means if you deduct 7 million from 45, it gives us 38. And it's on top 38 that we charge this. But again, because in this case, it's only the parent that will suffer the impairment loss, it then means that NCI will not be affected in this case. NCI will just simply have its own charge exactly on 45, okay? Because the impairment loss on the goodwill have no effect on non-controlling interest. Rather, for the parents, the impairment loss on the goodwill have effects by applying the 80% multiplied by this 45. Now, this 45 have not yet considered the impairment loss of previous years. Therefore, I deduct the impairment loss of previous year from this 45 to give me 38, 80% to give me 38. Now, in this case, I'm only going to find 80% of 45 first and deduct the entire 100% of 7 million. And that's how I'm able to get my 29, all because I'm simply doing what? Finding 80% of 45, which is 36, and I've deducted the entire 7 million because that 7 million is solely attributed to the parent as a result of the fact that we are dealing with a partial goodwill. And that is how we're able to produce these results, which means whenever it comes to the fact that it's a partial goodwill, not only that within the profit, we attribute that partial goodwill impairment loss to the parent. Also in the consolidated retained earnings brought forward, ensure that NCI is not affected by such previous impairment losses, but it's only the parent that is only affected with previous impairment losses. And that is the position as at this point in time. And that's how we are able to produce these results. Now, in our consolidated statement of changes in equity, we have our share capital at 200. We have our opening retained earnings as 149. Remember, it's flowing up from here, 149. And we have our NCI at 39, which is flowing up from here, 39. And 65 is flowing up from here, 65. And 5,000 respectively for profit attribution between non-controlling interest and the owners of equity. And that is the position we have as of now, which means you must always recall all of the principal lands with respect to full goodwill and partial goodwill. What results into recognition of full goodwill? What results into recognition of partial goodwill? And how do you treat impairment loss on full goodwill as opposed to impairment loss on partial what? Goodwill. These are the information we need to take note. And take note of this. In this situation here, it's so clear for us to understand that non-controlling interest in this case was measured as proportionate share. And that is what makes us to know that this goodwill is a partial goodwill. Any question on that? Any question on that? Take note of it again. The treatment of prior periods impairment loss on goodwill. What effect will it have on consolidated retained earnings brought forward? And those are the things we've done here and what we've done here. Take note of them at every point in time. Any other question? For those with noisy background, you can send a chat if you have a question. And if you don't, please kindly signify. Remember, this 12 million is a partial goodwill. Hello, Samuel. I'm sending a chat. Background is busy. Your network is bad. Please send a chat, Samuel. Your background is noisy and your network is bad, please. Okay. I'll wait your question, whether by chat okay. Since there's no question, therefore, we'll look at other principles. Now we still have other principles that we are going to look at. And those principles are issues that borders on unwinding of discount on deferred and contingent consideration. Similar principles, we look at it for prior periods and current periods. There were two examples there. We also look at treatment of preference dividend in the situation where the whole of preference share is held by the parent, or nothing is held by the parent, or partly held by the parent and partly held by others. And I think we are going to look at that in the next section to wrap it up. Any other question, consideration? Otherwise, we'll call it a day. Any other question, contribution? And I want us to go back and digest all of what we've done in the last three parts. This is a part 3 of our discussion on consolidated profit, statement of profit or loss, and other comprehensive income. Therefore, we also expect us to have sound and firm understanding of this, and thereafter, we'll come back and discuss other pertinent issues, such as unwinding of discount, which will lead to recognition of finance cost in the consolidated statement of profit or loss, and treatment of preference share dividends in group accounts. In that case, we'll wrap it up in part 4 on the aspect of consolidated statement of profit or loss and other comprehensive income, and that of the consolidated statement of changes in equity. In that light, I say thank you very much, and God bless you all. Bye.
Thank you, sir.
Thank you, sir.
Yeah.